Gentlemen, and welcome to the entitlement of the Biden administration's fiscal 2023 revenue proposals. This tells us what the Biden administration is trying to do to raise taxes. And it's a goozy. I mean, there's a lot of tax raises here. Fortunately, we have tax lawyer and CPA Brandon Ketron to lead this discussion. And unfortunately, we have Alan Gassman with him as well. If you have any questions, you can email them as you see their emails below on the screen. And now, since it is 11 a.m. Eastern Standard Time, at least in Florida, we will start the presentation. And those of you who are not so good looking, please turn off your cameras. Okay. Well, it was an interesting evening last night reading these proposals. And one thing that's really nice about reading tax proposals as opposed to reading new tax law is that you can actually figure out what they're talking about. The second thing that I enjoyed was that there's some new twists and turns that I hadn't expected. But for the most part, they took what they were going to do before. They narrowed it down a little bit. They added a couple of things, and it would be interesting to help clients save tax money if these proposals go through. Now, for those of you who have not joined us in the past, this does not qualify for continuing education credit, primarily because it's not good enough. But if you want a certificate of attendance, let us know. We'll be glad to give you a certificate of attendance. If you have questions, go to the panel bar, click on the upside down pyramid, and type in your question. And if we know the answer, we'll answer it. And if we don't, we'll pretend we didn't see it. We have a Saturday series, all free and almost all worthwhile. And this Saturday at 11 a.m., I'll be talking about asset protection meets estate tax planning. We post all of these to our YouTube channel and welcome you to meet us there. In just a few hours, Bradley Burnett, who is a really good presenter, is going to teach me some new things about S corporations and especially the new Form 7203 that CPAs are tearing their hairs out over. And let's just go straight to the new rules. So Brandon, do you want to just take us through what we see as the biggest takeaways and some implications? We're going to go through all of these. It's probably going to take 10 to 12 minutes, and then we're going to take a deeper dive.
Yeah. So what we've done here is we try to, bring out the highlights. We've taken the 250 pages from the Green Book and made 18 key points on 3 slides. So hopefully that'll simplify things. Now, there's a lot of other things that aren't mentioned here, but these are the key ones that affect us as estate planners and as high income individuals. So number 1, the corporate income tax rate scheduled to be increased to 28% effective January 1, 2023. And before we go through these, I just want to note, these are all proposals. None of this is law. It'll be months before this is even passed, if it's passed at all. So don't think that these things apply. It's just what could potentially apply and what they're targeting. Number 2, this was an interesting one, a new business tax credit equal to 10% of certain eligible expenses incurred when bringing back a business to the United States. So if a business is offshore in a foreign jurisdiction, company decides to bring that back to the United States, you would get a tax credit for doing so. So a nice incentive there to bring business back to the United States. Number 3, this was an interesting one that hasn't been in any of the other proposals or on the the IRS target list. Is basically new rules that prevent basis shifting between related parties by using partnerships. So what you can do here, and we'll go into a little bit more detail, but just a quick summary is, if you have one partner with low basis assets and another partner with high basis assets, you can actually transfer that basis and get high basis to one other partner and basically get the low basis to an older partner who would be getting ready to pass away, get a step up in basis, and then everybody has high basis. So there's new rules in place that would prevent that. And we'll go through that a little bit more detail in some slides or a future presentation if we don't have time today. Number 4, all of the fossil fuel tax preferences, most notably the intangible drilling cost that you can expense and get a nice write-off for those, have been or will be eliminated under this proposal. The top marginal rate for taxpayers will increase back to 39.6, what it was previously. That's going to apply for income exceeding $450,000 for married filers, $400,000 for single filers. So not only do you get a higher rate, but the bracket is a little bit more compressed as well from what it is today. Number 6, capital gains rates, dividends, taxed at 37%, the highest ordinary income rate. So that could even be 39.6 if you have income exceeding $1 million, and that's effective on the date of enactment if this is passed. And we don't read this to be a cliff, where, if you have over $1 million and all your capital gains are subject to 37%, we're reading it as if to the extent that they exceed $1 million. So if you had $1,100,000, only the 100,000 would be subject to this high rate. We'll have to ultimately see what the statute says when it's passed, but that's the way we're reading this Green Book proposal. Number 7, unfortunately, now this new concept of basically deeming transfers on death or by gift as realization events for income tax purposes. So if you had an asset worth $1 million and your basis was only $100,000, you would have $900,000 of gain that would be assessed, and you would pay capital gains tax on death or if you transferred that asset by gift. Now, there's certain exceptions for spouses and charities and transfers to those individuals, and then there's an exclusion of up to $5 million. So this won't affect low income or people with a low net worth, but us high net worth individuals and the people that we do plans for would definitely be impacted by this new rule. So Alan, any comments on 1 through 7 here before we go to the next slide?
Well, number 7 takes my breath away. I mean, number 6, to go sell your business for $100 million and have to pay $37 million of income taxes, that really is going to change people's decision making as to whether to sell their business and whether to sell it this year before this type of rule would go into effect. But then secondly, to give your daughter a $10 million home on the beach that you've always wanted her to have and be treated as if you sold that home, that's going to definitely cramp some styles. Let's say that.
Yeah.
It's very interesting.
Yeah, and I see 2 questions here. One about if they do have this appreciated asset deemed as sold, do you still get a step up in basis? And yes, you would get a step up in basis, just like if you sold it to a third party, the third party takes, whatever the fair market value is. So you would get a credit for the taxes by stepping up the basis, but you would have to pay the capital gains taxes, unlike today where you die, you simply just get the step up. And then the other one is, does this decrease the estate tax by reason of having to pay the income tax? And we don't know the answer to that. That's not in the proposals. Presumably there would be a credit, but we'll just have to ultimately see what comes in the statutes if this is passed. So number 8, we know this definitely applies for the deemed sell on death as far as valuing the assets. And there's going to be no valuation discounts unless it's an active trade or business, and then only to the extent that the assets are used in the active conduct of that trade or business. What we're not 100% clear on is if this also applies for gift and estate tax purposes, whether they're eliminating valuation discounts for everything or just for purposes of assessing this new deemed realization income tax on a gift or upon death. So we'll have to wait and see what comes about with number 8 here, but the use of valuation discounts could be impacted significantly if this proposal goes through.
Hey, Brandon, we've had about 40 people join us since we started. So I'm just going to back up a drop here and if you've just joined us, the only thing we've done so far, besides make some bad jokes, was cover the basic changes. We're going to get into more detail. But under number 7 here, if you transfer appreciated assets as a gift to somebody, the law would make you pay a capital gains tax as if you sold it, if you go over a cumulative lifetime amount of $5 million. So that's going to be shocking And to value what you're giving, you're not going to be able to take valuation discounts. So if I give 49% of $1 million company, I can't say it's worth less than 490,000. Now that valuation discount limitation that Brandon mentioned under number 8 here is only mentioned in the section on this imputed sale on gift. It's not listed in the estate and gift tax discussion, and it's not listed in the $100 million family tax discussion. So we can't be clear on that. So number 9 here, and this is for taxpayers having a net worth of over 100 million. They will be taxed instantly as of January 2023. Net worth over 100 million, great. What if you sold it all today? What would your tax be? Okay, pay us that over the next 10 years in annual payments. And we're going to measure you now every year for the rest of your life, as long as you're over 100 million, and treat your assets as if they all got sold. So I think there's going to be a lot of families that are going to be setting up private foundations and charities that, quite honestly, they've been thinking about it anyway. But if you're at 130 million, 120 million, you want to get your planning done and your asset values compressed before next year. I think that's just a loud message, because if you're over 100 million, not a lot of Americans are going to stick up for you. If it applied to people over 10 million, a lot of people would stick up for you. But that, we're going to go over that in more detail. Number 10, they just about copied and pasted from the Bernie Sanders bill to limit the utility of grantor retained annuity trusts. Most of the people don't need a grantor retained annuity trust, but they just pretty much copied it right out of his bill. Section 11. Now, this is a trust that I establish. It's irrevocable. It's out of my estate for estate tax purposes, but I could trade assets with it. I could pay the income tax attributable to its income without that being considered to be a gift to me. And I can sell assets to it for a low interest promissory note. And whoever wrote this proposal knows about these things and doesn't like them, because what they said was, if you form a new grantor trust after enactment of this law and you pay the income tax on its behalf, then that's considered to be a gift to the trust. But if you're grandfathered and you are still paying the tax on its behalf, you're fine. Now, if you transfer assets to the trust in exchange for a note, even if it's an old grandfather trust, if you do this after enactment of the act, you're going to be treated as if you sold those assets at fair market value. So there will be an income tax. And then the final thing they said, and I'm really surprised that this was in there, they've obviously been watching Jerry Hesch's videos. If I sell assets to a trust for $1 million note, bearing interest at 2%, which is the applicable federal rate, for 25 years, then I can go to an appraiser and have that note appraised at about probably $7 million. That's what it's worth. That's been a gaping loophole in the estate and gift tax arena. Well, that's going to be gone. They're saying that when you value one of these low interest notes, you have to assume that it's a short-term note due within 3 years. So your discount is going to be much smaller. So that's number 13. Number 14, more information returns. The government's going to want to know about these trusts and what's in them. We haven't told the government of this because with a defective grantor trust that's disregarded for tax purposes, you don't have to report what's in it. But that would change. Number 15, the generation skipping law, which allows me to put $1 million worth of assets into a trust that would go 1,000 years if I used South Dakota law. It could go 1,000 years without ever being taxed at anyone's level. Well, that's now going to get popped every third generation. So if I set up a $10 million trust tomorrow, it's only going to be estate tax free as to my children, my grandchildren, and any great grandchild that is living at the time I set it up. Number 16, the hedge fund people who manage hedge funds and get a piece of the profits. Usually it's 20% of the profits, and they pay capital gains tax. Now they're going to pay ordinary income tax if this passes. That was the Warren Buffett statement, that his secretary was in a higher tax bracket than he was because how he can get paid is tens of millions. 1031 like-kind exchanges will be limited to $500,000 per year per taxpayer. Here's another real sting, and this one surprised me too. If you sell property after enactment that you depreciated and it's real estate, you have to recapture the depreciation as ordinary income. That's not true now. Right now, if you take straight line depreciation, you recapture it at a capital gains rate. So that's going to really, really put the real estate industry into a tizzy. And then finally, if you have a private foundation and you want to make your 5% per year minimum distribution, you have to give it to charities other than a donor advised fund. The 20th thing that we'll put down here, which really did shock me, is right now, before you sell a capital gains asset, you can put it in a charitable remainder trust, get a little bit of an income tax deduction, then the charitable remainder trust sells the asset, and you don't pay any income tax until gradually as you get your payments from the charitable remainder trust. Well, that day would be gone. If I sold an asset, if I transferred a $1 million asset to a charitable remainder trust that has a 10% value of remainder to charity, $900,000 value of my annual payments for life, then I'm going to have to pay income tax as if I sold that asset, or as if I sold 9/10 of that asset for $900,000. So they're on to that one, and I think that'll hurt some charities because I don't really think that charitable remainder trusts are abusive, but apparently someone thinks they are. So Brandon, with 14 minutes left for deep discussion, where do you want to go first?
Yeah, let's. So I think the tax increases are fairly self-explanatory here. Corporate income tax to 28%. We talked about the long-term capital gains and the adjustment to the marginal rates as well. Let's talk a little bit more about this minimum tax on wealthy individuals. So again, this is people that have net worths over $100 million. As Alan put it, they face this constructive sell tax. So basically all their assets are treated as having been sold on the date of enactment of this statute. Now, fortunately, they do get a repayment period or payment period for this tax over 9 years, since it's a little bit of surprise and shock to those wealthy families. But then after that first year, you're deemed to have sold all your assets again, and then you only have 5 years to pay it. So you get the one-time hit with the 9-year payment plan, and then everything else is over a 5-year payment plan. And just to go into a little bit more detail on it here, these are essentially treated, as you can see on the bottom, and this is language directly from the Green Book on this proposal, is it's essentially treated as a prepayment of the capital gains taxes. So then when you ultimately would sell the asset that you've already paid this tax on the unrealized gain, you get a credit back for that. So you don't get double tax, but you do basically prepay the tax to the extent that the unrealized appreciation is there. So this will be an interesting one. We'll see where this heads, but a significant impact for wealthy individuals. And Alan, I know you've talked about charitable planning is going to be a huge part of this to get under that $100 million threshold. And I think there's a little bit of a phase out range as well, between 100 and 200 million dollars. So you may play with those numbers as well to try to just stay as low as you can and get underneath this.
Yeah, and we're constantly amazed. There's a lot of tax advisors on this webinar. We're constantly amazed at how often somebody walks into our door and says, well, I really need to get my estate planning done. I've never done a will. Okay, well, what are your assets? Well, about 120 million. Okay, well, if we set up an irrevocable trust for your children and a limited liability company, we could probably get that down to 90 million in about 2 weeks. So those families are going to continue to come out of the woodwork, and or they're going to pay a lot of taxes. And as a fellow taxpayer, I thank them sincerely.
All right, so then next we have just again the summary of the estate and gift tax changes, but I wanted to get into a little bit more of the details and the actual language here from the proposals and talk about how this is going to work. So again, transfers of appreciated property treated as having been sold to the extent of the fair market value on the date of the gift. And you, as mentioned in the second paragraph down there, that this is valued the same way it's valued for gift and estate tax purposes, but with the following changes. You don't get a discount for partial interest like you do with estate and gift taxes currently, and you only get that discount if it's an active trade or business. So if you put money into a partnership, transfer basically your investment and brokerage accounts in the partnership or a disregarded entity have 99% non-voting, 1% voting, you transfer the non-voting interest, so it's not a controlling interest. Typically, you would get a discount there. Not for this purpose. It's basically a pro rata value of the entire asset. The other time that this could apply is distributions in kind from a trust, transfers of property into a trust, transfers of property by a partnership and other non-corporate entities to the extent that those are deemed to be gifts. And I think that's an important concept too, because I do see one question about transfers into revocable grantor trust, of whether that would trigger this rule, and it doesn't, because those aren't deemed to be gifts. This only would apply if it is a transfer to an irrevocable grantor trust that results in a gift, or if you have a transfer from, for example, from an incomplete gift trust that becomes completed, then you would also have this tax triggered as well. And talking a little bit about the exclusions here, again, we mentioned a transfer to a spouse just gets a carryover basis. So it's not a deemed realization event when you transfer assets to your spouse. The basis just carries over like it does today. And then if the spouse would gift that asset to your children, or the spouse passes away and it passes to the children, that's when this is triggered. So you get a deferral there for assets to the spouse. Also, transfers to charity aren't subject to this rule. You get an exclusion there, and then when the charity ultimately sells the asset, it's not subject to income tax either. And then there's also a concept of portability involved here as well. So this $5 million exclusion, to the extent that one spouse doesn't use it, it can carry over to the surviving spouse, similar to the way the estate tax exemption works, where it can carry over to the surviving spouse. It's indexed for inflation, so it does increase, and it's both a lifetime and a at-death exclusion. So if you use $3 million during your lifetime, you would only have $2 million remaining upon your death. And to the extent that the gain exceeds that $2 million, you would be paying capital gains taxes on that transfer. All right, so we talked about the grantor trust proposals as well. Deemed realization event for transfers to a grantor trust that's not fully revocable. Again, that's key language there. So transfers to a revocable trust are still fine. And it only applies after the date of enactment. And I think that's another interesting thing about all these Green Book proposals, is none of them really have retroactive effect. A lot of the prior proposals that were out there would have been effective, say January 1 of the current year. These proposals are all effective after the date of enactment. So there's still things that we can do and plan. For example, if you're planning on selling your business, you might speed up that closing date, so that way you don't have this ordinary income tax on the capital gains that would apply. So a lot of planning to be done quickly if these things do look like they're going to be coming law. All right, so I just wanted to mention this chart here and what you can still do today and not be subject to any of these rules yet, but this could be severely curtailed if these rules do become effective. And that's our typical installment sale. to a defective grantor trust. And we use this plan for most of our clients that are subject to estate taxes, and it does a really nice job of reducing the estate, and then also some other planning that you can do with it as well. So just an example, we have $20 million of assets under this LLC. It's owned, 1% by the client's client spouse, 49.5% non-voting by the client, and 49.5% non-voting by the client spouse. Because we're transferring a non-voting interest to this defective grantor trust, there's not going to be an income tax event because the trust is disregarded for income tax purposes, and we can take a discount. So the $10 million of assets roughly that are being transferred might get a discount of, say, 30%. So that's $6,930,000 of assets. You have a note back to the client for that at the applicable federal rate, which is now around 2%. It's increased a little bit since we created this slide. And then the client spouse can do the other thing on the other side. I'll talk briefly about why we have this trust on the right just for descendants only, is because of the reciprocal trust doctrine. We can't have it be for one client creates this trust for their spouse, the other spouse creates a trust for the other. That just doesn't work well for estate tax planning. So what happens at the end of all this? Well, 10 years later, if the assets double in value, we have $20 million of undiscounted assets under this trust, $20 million of assets under this trust, and we only owe around $7 million back to the client. So we've taken their estate from being $40 million only down to $14 million combined, and been able to pass the growth and appreciation to these trust, estate, and gift tax free. Now, these proposals would change a lot about this. Number one, we might lose the discounts. Number two, you would pay income tax on the sale. Number three, while we're paying all the income taxes each year annually, that's going to be considered a further gift to the trust. So this type of planning is great now, but again, these proposals would limit the utility of it. So if you are interested in this type of plan, make sure you're reaching out to the appropriate advisors and getting these things finalized before this would become effective. Alan, any comments on that?
No, I think it's just get to your tax lawyer before they're filled up so that you can get the stuff done that you should have done 20 years ago.
Yep, I agree. We mentioned GRAT's limited utility if this becomes effective by having this remainder interest having to be valued at greater than 25% or $500,000, and a very long term as well, minimum of 10 years for GRATs. Mostly when we do this with zero remainder interest, so there is no gift upon formation, and for short terms, 2-3 years maybe, and you can do those consecutively as well. And GRATs work great today if they're appropriate, but would not work great after these proposals. One thing that wasn't mentioned, which was interesting, is no mention of reducing the estate tax exemption, which had been in all of the other proposals. I guess they're just now relying on it scheduled to be going down at 1/2 in 2026 of what it otherwise would be, but there was nothing in there that would reduce it quicker than in 2026. So I thought that was an interesting note as well. This basis shifting, I don't have a whole lot of time to go through, but I talked about it briefly before, and it would not be useful after the enactment of these proposals. But what you can do today is say you have a building in a partnership that has very low basis that would all be subject to gain upon the sale of the building, and you have let's call it grandfather owns the partnership with son, and son contributes $1 million of bonds with $1 million of basis into that partnership, and then after a couple of years, you can't do this immediately, but you have to wait, and there's some other rules that would apply too that you have to be aware of. The partnership distributes the building to the son. Because of the partnership rules and the way that works, the son takes basis in the building equal to his basis in the partnership, which is the $1 million. So now son has a $1 million building with $1 million basis. It can be sold tax-free. Grandfather remains in the partnership with $1 million of bonds with no basis. Grandfather dies, 754 elections in effect, step up in basis applies. Now son has his $1 million of bond back with $1 million in basis. So that can all be done today. There's some rules that apply that you have to be aware of, but after this would pass, it would not work. So remember those rules, and if you're interested in something like that, get it done sooner rather than later.
Beginning on page 34, for your later reading interest, we have how many billions of dollars will be raised by these various situations. So, there are billions of dollars going on through these partnership exchanges that, although one asset has to be in there at least 7 years and another at least 2, to do this, if you're a CPA or a lawyer and you represent families with large partnership interests, check out everybody's basis and the basis of the assets and see if they're better off pulling assets out and into the hands of somebody with a high basis and selling them before this type of thing will go into place. Now, on the estate and gift tax side, not a huge impact, but still looks like 452 billion, maybe. I mean, a lot of money.
They're in millions.
Yeah. Okay, are going into these techniques that we are using. So finishing on time is one of the criteria, and we've done that. Brandon, do you want to answer any of these remaining questions?
Yeah, let's see what we got here.
Gail says if you're in a payment plan for $100 million in assets, if you sell the following year, have you gotten a deferral that they wouldn't have otherwise gotten? No, I don't think so. I mean, I think you're considered to have sold in the first year.
So yeah, I think that would speed up the deferral. You would, pay at the time of the sale versus being able to defer it.
Oh, okay. So it would be like a 6166 payment plan with the IRS.
Right. If
you got to pay.
Yeah, once you sell the asset, I would think that you would no longer be able to pay over the 9 years. It would become immediately due as capital gains tax.
And then Tony says, is there any guidance on how privately held corporate stock would be valued? Well, for the $100 million family, it's just going to be the value of the company multiplied by the percentage they own. In the other areas of estate and gift tax planning, we hope that we'll be able to use valuation discounts, because this green book only mentioned discounts in the context of a 100 million family, and also mentioned that if it's an active business, you could take the discount. So much more reasonable and much more balanced than what we saw from the Bernie Sanders plan.
No. I see one question on whether the transfer rules to the effective grantor trust apply to irrevocable life insurance trust, and yes, that they do as well. So you would have deemed realization events if you transferred assets in and out, even if it's a life insurance trust.
But it's okay to pay the premiums on a life insurance trust.
Right.
I mean, so most life insurance trusts, if you have a split dollar arrangement where you're advancing the premiums or you pay the premiums into the trust as a gift, there's nothing in this green book that interferes with that. So I guess the politicians got all the money they needed from the life insurance industry. They didn't need to put anything in here to threaten life insurance. One of my law professors used to always tell me that they just always put something in there to try to hurt the life insurance industry so that they'll all donate to the politicians to vote against it. But that didn't seem to have happened here so much. So another question is, how soon will all of this happen? Well, hopefully it will never happen. And we won't have to learn a lot of new tax laws and have a lot of webinars. But the legislative process is pretty unpredictable. In my opinion, this isn't going to happen unless Democrats win more seats in the midterm elections. But this would be their blueprint that I would expect for them to follow if they do. Brandon, any final word?
Another question here, just a clarification about the payment of income taxes on grantor trust. It does not apply to pre-enactment grantor trust. So if you have a grantor trust in place, you can continue to pay the taxes on that trust without it being a deemed gift. After, a trust created after the enactment date, if you pay the taxes on that trust, to the extent that the trust doesn't reimburse you for those taxes, it's a deemed gift to the trust. So that was an interesting concept as well in the proposals, that they talk about reimbursement to the grantor of taxes paid on behalf of the trust would not cause a gift, but if you don't have that reimbursement clause, it would be considered a gift to the trust. And then that brings in a whole nother issue with whether or not the reimbursement clause causes inclusion in the estate. So it'll be interesting to see what comes of this, but wanted to clarify that point there. Let's see, anything else? I think that's good. I see some other questions here that are a little bit longer that I'll have to read through, but I think that covers most of them.
Yeah, so you've got our email addresses there. As always, please send Brandon the hard questions and me the easy questions. We'll keep you posted, and please consider joining us on, if you go to our YouTube channel, you'll see a lot of YouTube videos on the basics of estate planning and a lot of YouTube videos on charitable planning. It's all free and almost worth it to watch these. And then we always have our Saturday at 11. If you send us questions, we'll go ahead and try to answer them on the webinars that we present. I apologize. Somebody sent me a question about an hour and a half ago, and I said I'll answer it on the webinar, and I forgot to, and I forgot what the question was. So I'll answer you later. In any way, you'll get a copy of this webinar video, I think in about 2 hours, Kelsey willing, and then you can feel free to share it with anyone you like, whether you like them or not. And just keep us posted. Thank you very much for listening and watching.